All right, real fun one today. We're talking about the federal income tax. Get excited. We're going to be looking at our tax system. We're also going to be looking at filing tax returns. All right, so buckle up and hold on to your seats. So the purpose of taxes, why do we have taxes? Well, the duty of the governments are to provide for us. And in order to provide for us, they have to have money. So from time to time, the government collects money from the citizens of the country on a regular basis, and these are taxes. The funds that are sent to the government are most commonly known as revenue. So that's why taxes exist, so that the government can provide services for people. In the United States, we have what's called a progressive tax, which means as you go up the pay scale, your income is taxed at a higher percentage. So the more money you make, the higher percentage of income tax you are paying. The less amount of money you make, the lower percentage of income tax you're paying. A regressive tax would be taking a smaller share of income as the amount of income grows. Some consumption taxes, pretty much all consumption taxes are regressive, meaning a consumption tax would be like sales tax, right? So if you buy, let's say you buy a PlayStation, you would have a sales tax on that, and it's the same that anybody else would pay. So whether you make $10,000 a year or you make $1 million a year, you're paying the same tax on that PlayStation. But if you're making $1 million a year, the tax on that PlayStation is a much, 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 much lower percentage of the amount of money you make in a year than the person who makes $10,000. So that's an example of a regressive tax. Even though it's a fixed price and a fixed tax amount, it represents a smaller percentage of your income the more money you make. Hopefully that makes sense. Proportional taxes are taxes for which the rates stay the same regardless of income. So property taxes would be an example of proportional taxes. So again, regardless of how much money you make in a year, if you live in a house that has the same value as your neighbor, you're both paying the same property taxes regardless of your income. The IRS, which is the Internal Revenue Service, they enforce tax laws and collect taxes. Congress has the power to create tax laws, and tax rates apply to what are called income tax brackets. And we'll look at those in a minute. But when every citizen is required to file a tax return, it's called voluntary compliance. That's what we have in the United States. Failure to pay taxes can result in a penalty. Tax evasion is a crime. It is not paying your taxes, willful failure to pay your taxes. It's a serious crime. You could be fined or put in prison or both. Every year, the IRS calls millions of taxpayers for what's called an audit, which is an examination of their tax returns. So there are a few different types, but essentially, if you get audited, then an IRS agent is coming to your place of business to look through, or your home, to look through your tax records to make sure that you've been truthful and accurate in your tax payment. Filing status. This is something that you would fill out in a W-4. It describes your tax filing as of the last day of the tax year. So either you are single, meaning not married, you're a married person who's filing a joint return, meaning the married couple is filing together. You could be married and filing separate returns. You could be the head of a household. You could be a qualifying widow or widower. An exemption is an amount that you may subtract from your income tax for each person who depends on your income to live. So let's say you have 3 children at home. You could have 3 exemptions from your tax, and then that would lower the amount of taxes that are taken out of your income. Exemptions. So who qualifies for exemptions? It would be yourself, your spouse, if you're filing jointly, and then your dependents. So again, dependents are people who live with you that you have to pay for more than half of their living expenses. Gross income is all the taxable income you received. We talked about that in Chapter 6. Earned income refers to the money you earn from working, and then unearned income refers to money you receive from passive activity, meaning it could be your stocks or bonds or gifts or maybe inheritance, things like that. Not going to go through all the common types of income, but you can take a look at that if you want to pause. The adjusted gross income. The law allows you to subtract some types of spending from your gross income. And you can adjust your income by subtracting things like contributions to your retirement account, student loans, tuitions, and fees. So basically what that means is, let's say you make $50,000 a year, but let's say in that year you spent $10,000 on your retirement accounts and your student loan interests and tuitions and fees for college. That would mean that you would reduce your taxable income by $10,000. That's what this allows you to do. So instead of the government looking at what you made in the year and seeing $50,000, they actually can only tax $40,000 of your income. And that's the idea of adjusted gross income. So part of the way to get your taxes down is to consider ways to smartly increase the amount, to smartly subtract from your income in different ways. Taxable income is the income on which you pay tax, obviously. So that would be wages, salaries, tips, etc. So your income and your earned income and your unearned income are both taxable. So if you made money on interests in bank accounts or dividends, which would be like making money off stocks, other things that are unearned income, those are taxable. There are some things that are non-taxable, depending on, it sort of depends, but child support, gifts, inheritances, to a certain extent, life insurance benefits, veterans benefits are non-taxable. So you take first your gross income, and then you eliminate the adjustments. You eliminate deductions, you eliminate exemptions, and then you are left with your taxable income. There are also itemized deductions. So things like medical, these are expenses you can subtract from your adjustable gross income to determine your taxable income. So you can deduct things like your medical expenses, income taxes, your property taxes, your mortgage insurance, gifts to charity. These are all things that you could use to itemize deductions. There's also something just called the standard deduction. So if you don't have a lot of deductions, you can just take what's called the standard deduction, and it's a stated amount that you may subtract from your adjusted gross income instead of itemizing all of your deductions. So right now it's $12,200 for individuals or $24,400 for married couples. And essentially what that means is if you're married and you and your spouse make $100,000 a year, you take the standard deduction, then your taxable income automatically reduces by $24,400. You don't have to go through all of your records and figure out how much did you give to charity and how much did you pay in property taxes, et cetera, et cetera. For most people, taking the standard deduction reduces your taxable income by more than any other method. There are also things called tax credits, which is an amount that's subtracted directly from the tax you owe. It's different from a deduction, because a deduction is subtracted from the adjusted gross income, and a tax credit actually reduces the tax. So the government allows tax credits for some education expenses, childcare expenses, and other reasons from time to time. When you're thinking about your income tax return, everybody must file income taxes if you earn enough to owe them. No later than April 15th, although this year they extended that because of coronavirus. There's different forms that you have to use. So basically, you could either pay an accountant to do your taxes for you and file with the government. You could do it yourself through electronic programs like TurboTax, etc. I'm not going to go through this. Okay, that's it. In terms of tax, I know it was a wild ride. Hope you enjoyed it.